December the 2nd, 2001. Thousands of employees walked into work on a Monday morning expecting a normal day. Instead, they found locked offices, frightened co-workers standing in hallways not knowing what to do, and a company that was collapsing in real time around them. Some lost their jobs that day. Others lost everything they had saved for retirement. Investors lost billions of dollars before lunch. The company was Enron. Just 6 months earlier, Fortune magazine had called it one of the most innovative companies in America. Its stock was flying. Its executives were celebrated. Its future looked limitless. So how did one of the most powerful companies in the country vanish almost overnight? The answer is not just about money. It is about what happens when an entire organization decides that looking successful matters more than being successful. In the 1990s, Enron was the kind of company that made other CEOs nervous just by existing. It started as a natural gas pipeline company in Houston, Texas. Boring business, stable but unexciting. Then new leadership arrived and decided boring was not good enough. They transformed Enron into an energy trading company, buying and selling electricity and gas across the United States, like a stock market for power. It was aggressive and innovative, and it worked for a while. Wall Street fell in love with Enron. Analysts gave it the highest possible ratings. Investors could not buy the stock fast enough. The Houston headquarters became a symbol of American business power. Business school graduates begged for jobs there. Everyone wanted a piece of what Enron was building. But inside the building, a completely different story was unfolding. The problem was simple, even though the executives made it as complicated as possible to hide it. Enron was not actually making the money it said it was making. Certain business ventures were losing money, significant money. But instead of reporting those losses to investors, the way every public company is legally required to do, Enron's executives created a maze of separate companies specifically designed to absorb the losses and keep them off Enron's main financial statements. On paper, Enron looked extraordinarily profitable. In reality, the debt was piling up in the shadows where nobody was looking. The more complex they made the financial structures, the harder it became for outside analysts to understand what was actually happening. And that was entirely the point. Confusion was the strategy. If nobody could understand the numbers, nobody could prove the numbers were wrong. Not everyone was fooled. A small number of financial analysts started asking uncomfortable questions publicly. One journalist wrote a piece suggesting that for a company claiming such extraordinary profits, Enron was surprisingly reluctant to explain exactly where those profits were coming from. The CEO responded by calling that journalist an asshole on a live earnings call. The journalist turned out to be right. Inside the company, one employee saw it clearly before almost anyone else. Sharon Watkins was a vice president at Enron who understood the accounting well enough to know what it was hiding. She wrote a memo directly to the CEO, warning him that the financial structures were fraudulent and that the company could implode in a wave of accounting scandals. She handed that memo to the most powerful person in the building. He handed it to the lawyers who were already helping design the structures she was warning about. The warnings went nowhere. Meanwhile, executives who knew the truth were doing something else entirely. They were selling their own Enron stock as fast as they legally could, quietly liquidating their personal holdings while publicly telling employees and investors that everything was fine and the stock was a great investment. Employees who had their entire retirement savings in Enron stock were being encouraged to buy more by people who were secretly selling everything they owned. When the end came, it came fast. A series of required financial disclosures forced Enron to reveal some of the hidden losses. Not all of them, just enough to shake confidence. That was all it took. Confidence in a company is like oxygen. You do not notice it until it is gone. And when it disappears instantly. The stock price that had sat above $90 per share began falling, then collapsing. Within weeks, it was below $1. Banks that had been lending Enron money stopped returning calls. Credit ratings collapsed overnight. Investors who had trusted the numbers for years realized simultaneously that the numbers had never been real. On December 2nd, 2001, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. $60 billion in assets gone, 20,000 jobs gone. The retirement savings of thousands of employees who had spent careers building a future inside that company gone. The executives who had designed the fraud and sold their stock while telling everyone else to hold on Several of them went to prison. The CEO was convicted on multiple counts of fraud and conspiracy. The accounting firm that had signed off on Enron's fraudulent financial statements for years lost its operating license and ceased to exist entirely. An entire major accounting firm destroyed as a consequence of one client's fraud. The collapse of Enron directly led to the Sarbanes-Oxley Act of 2002, which completely overhauled how public companies in America are required to report their finances. Regulations that exist today protecting millions of investors were written specifically because of what Enron did. The warning signs were there for anyone paying close attention. A company that cannot clearly explain where its profits come from. Executives selling their own stock while publicly praising it. Financial statements so complex that even experts cannot follow them. Employees who ask questions being quietly moved aside. Every single one of those warning signs was visible before the collapse. Most people just did not want to look, because when a stock is rising and the story sounds good and everyone around you believes it, it takes courage to be the person who asks the question nobody wants to answer. Sharon Watkins asked that question. She was ignored. She later became one of Time magazine's Persons of the Year for her courage in speaking up. But by then it was already too late for the thousands of people who lost everything. The story of Enron is not really about accounting tricks. It is about what happens when the pressure to appear successful becomes more powerful than the commitment to actually being successful. It is about how smart people convince themselves that bending the rules is temporary, that they will fix it later, that nobody will find out. They always find out. The house of cards always falls. The only question is, how many people are standing inside it when it does? So here is the question that every investor and every employee and every person who works inside any organization should ask themselves. If you could not explain where the money was coming from, would you trust it? Drop your answer below. Follow for more stories about the companies that fooled the world and the moments when the truth finally came out.